Our third theme for global equities is expect more muted returns with the bar being set high. Now let's start specifically in the U.S. equity market. We've seen over the past couple of years that valuations or price to earnings multiples have expanded significantly. This has coincided not only with the Fed cutting interest rates aggressively, but also the artificial intelligence craze and that fear of missing out. But what we've also seen is that the rally has been very concentrated in a select few names, or what we call the Magnificent Seven. These stocks have really driven almost 100% of the total return that we saw last year for the S&P 500. So we think when you look at areas of the U.S. equity market, specifically technology, large cap growth, these are trading with almost bubble-like characteristics. Look at this chart, for example. The S&P 500, its earnings yield is below all of the bond yields across the curve. This type of phenomenon has not occurred since the dot-com bubble. So this is telling us that U.S. equities, specifically in the S&P 500, are expensive. Now, value in the S&P 500 is cheaper to growth, but it still is trading at a premium. Small and mid-cap stocks, this is an area we would love to add some exposure to. We're being very patient with this. These stocks are cheap compared to large cap stocks, but you still aren't seeing significant discounts in this part of the market, and they are economically sensitive as well as interest rate sensitive. If you want to find cheap equities, go outside the U.S. Diversify into the international markets. The developed markets look very cheap compared to the U.S., historically cheap. And when we look at investments for the long run, we want to make sure we're paying the right price. You don't want to overpay for something because everyone else is buying it. You want to pay the right price where the risks to the downside are reflected in those valuations. We're not necessarily seeing that in the U.S. You could almost say parts of the U.S. market are pricing for perfection. Instead, the developed international markets are historically cheap and reflecting the downside risk from an economic and an earnings standpoint. So they're a good opportunity to diversify away from the U.S.